Most people heard about this bill and felt a familiar reaction, a quiet pressure to pay attention, a sense that something important changed, and a worry that missing it could cost them later. If you're approaching retirement, that reaction fits because over the summer, every headline talked about the so-called One Big Beautiful Bill, more than 900 pages, promising changes for retirees, families, and taxes. What those headlines never explained is this: very little of that bill will ever touch your life, and a few specific sections quietly shape your taxes and income for decades. By the end of this video, you'll know which parts actually matter and why timing plays a bigger role than most people realize. Here's how I come at this. I spend my days helping people turn lifetime savings into income they can rely on. People who want to enjoy their healthy years without constantly second-guessing decisions. After years inside large investment firms and years sitting across the table from retirees, one thing became clear: legislation rarely creates winners and losers. Understanding does. So when a bill like this passes, I look past the politics and focus on what it changes inside a real retirement plan: taxes, income flow, and peace of mind. Let's walk through the three changes worth your attention. The first one is the new senior deduction. Starting in 2026, if you are 65 or older, there's an additional deduction on top of the standard one. $6,000 if you're single, $12,000 if you're married. And that helps. What often gets missed is how it works once income rises. Once income exceeds $75,000 for single filers or $150,000 for married couples, the deduction starts to phase out. Not all at once, but gradually. So here's where timing matters. Picture a retired couple with about $120,000 of income from Social Security and a modest pension. They decide this is a good year for a $40,000 Roth conversion. As their income rises past $150,000, the senior deduction starts shrinking. By the time the conversion is done, a meaningful portion of that $12,000 deduction is gone. In a 22% tax bracket, that reduction alone can translate to roughly $2,600 in additional taxes, simply from pushing income into the phase-out range. Split that same conversion over 2 years and more of the deduction stays intact for both years. Same dollars, different timing, very different result. This bill quietly rewards sequence over speed. The second area involves Social Security. Many people hoped this legislation would make benefits tax-free. It didn't. In 2026, the same thresholds still apply. Once combined income exceeds $34,000 for single filers or $44,000 for married couples, up to 85% of Social Security benefits can become taxable. You may have seen headlines saying most retirees won't owe federal tax on their benefits. That statement skips an important detail. Those numbers reflect retirees with very limited additional income. Once pensions, IRA withdrawals, or investment income enter the picture, even modest changes can cause more of your benefits to be taxed. The opportunity here is control, not eliminating taxes, controlling how much of your Social Security gets pulled into taxation. Withdrawal order matters. Account type matters. Timing matters. When those pieces work together, your retirement paycheck becomes steadier and more predictable without changing how you live. The third change is about family and legacy. This one tends to get overlooked. The bill expanded how 529 plans can be used, including credentialing programs, licensing exams, tutoring, and curriculum. And starting in 2026, the K through 12 withdrawal limit doubles from $10,000 to $20,000 per child per year, completely tax-free. Every contribution also reduces the size of your taxable estate. That creates a quiet planning opportunity. You can help children or grandchildren now reduce future estate exposure and still protect your own retirement security. Legacy planning doesn't start at the end. It starts with thoughtful structure. So here's the bigger picture. This bill didn't overhaul retirement. It created new pressure points where timing and structure make a meaningful difference. Headlines focus on size and drama. Plans focus on sequence. You don't need to read 900 pages of legislation. You need clarity around how these rules intersect with your income. If you want to see how these changes fit your situation, Roth conversions, Social Security, or family planning, there's a simple next step. You can schedule a retirement tax clarity call. We'll look at the moving pieces together and identify where small adjustments create long-term relief. Because when the rules make sense, decisions feel steadier and confidence follows.